Right. Today we're going to continue talking about long-term liabilities. And last time we kind of did a big overview. So just one more time to make sure that we are in the correct place here. We're going to start with our assets. And I know I put equal, but let's always think of this right here. When you're buying something, either you're going to pay for it, you're going to pay for it right now, you're going to pay for it later, or maybe a combination of the two, okay? If you were to pay for everything out of your pocket, then you would automatically own it and you would have equity. And the reason we think about ownership and equity is because when you're buying stock, the word stock is just another word for ownership. So if you put if you have all these assets here and they're all yours, you own all of them, so you have all equity, right? Now, you can also maybe put a little bit of cash in and then pay for it later. If you pay for it later, in general, this is just kind of in general, it's called a liability. And of course, you can, like sometimes when you go to the store, you maybe have some change you put in there and then you pay the rest of it on your credit card. So you can always have a combination of the two. So assets are bought either using your funds, equity, or borrowed funds, liability. Or you could say assets are financed by either liabilities or by equity. We're going to look at equity, and we know that anything that increases equity is going to be done through credit. Anything that increases liabilities will be done through credit. Anything that increases equity will be done through a credit. So everything we're going to talk about with liabilities and equity work the same. It's just a matter of which category are they in and what accounts they are, okay? So now, last time we talked about some long-term assets, but that's what I want to make sure that we understand. We're focusing on long-term liabilities. And these usually have to do with some type of interest involved, okay? Now, notes payable, we're kind of familiar with that from last time. Bonds payable works the same way a little bit, but we want to spend a little bit more time on bonds payable because it's a little bit different, okay? So, bonds payable, and this is not, by the way, there is no proper order that it must go in for this right here. Now, current assets, there's always going to be a proper order. But for these right here, there is no proper order. So, bonds payable is where we are today. Bonds payable. All right. So now, when you issue bonds payable, what does it mean to issue bonds payable? Remember, going back to our first example, if I have some assets and I put all of them in, then I own everything. We agree, right? But then I may need some more assets that I can't provide. It may be some more cash. So cash is usually easy, and that's what we're working out. So I want some more cash. I need some more cash. So I may have started with something, and I'm going to put here in green what I actually have. I may have had some cash. I probably previously had some cash, let's say $2,000, and everything that I had, once again, this would be my ownership, so this would be my stock or stockholders' equity. It would have been $2,000 in equity, right? But now, my business has grown, and I know I can make the sales. I just need the cash, like literally. You all know I can make these sales, right? So you decide to give me the cash. Now, if I get the cash from you, I am going to get cash, right? And I'm putting this in red. Even though it's an asset, I want us to understand that this is more related to over here. So my cash I receive now is going to be $1,000, okay? Now, the only question I have to worry about is, am I going to give you ownership in it? Excuse me, not am I going to give you, because I'm asking for your money. I'm really at your mercy. So are you going to require me to give ownership to you, or are you going to say, hey, I don't mind borrowing it, letting you borrow it, and pay me some interest on it? That's what we're coming down to. So I'm going to split this up to show that your assets can be financed one of two ways. It can either be financed through a long-term liability, okay, or it can be financed through a stockholders' equity transaction of $500. Now, I did separate this out by color but of course when we write in our books, it's going to be by name, okay? So colors are the same as name right now. Just know that these belong to you. You may have gotten together as a group and said, well, we don't want to take all this equity. Well, actually, 25% of equity is like really good. If you get 25% equity, that's good. I think 20% used to be the cutoff, but 25%, we know that's good. You're in a different, you actually have to do your accounting a little bit different for your taxes. So just remember that if you get that high of ownership. But you do have $500 of this. Now, only for this purpose, I'm going to, because we're both talking about long-term liabilities, I'm going to add another one, okay? This time, I'm going to issue, and when I say I'm talking about my company, so always think of this as your company. I'm going to issue just $100. I need $100. So once again, to say that I issue stock means that the company gains cash. To say that you issue a liability or a bond means that the company has cash, okay? So this is always from the company standpoint. So anytime you issue something, when Coca-Cola issues stock to us, they are getting cash. We are receiving just a little bit of ownership, but it's still ownership. That's why we get dividends, okay? So anytime the company issues something, there's going to be ownership. Now, I'm going to use this right here, and I want to put this ownership under bonds payable because this is where we're going to be today, all right? So we already basically have the journal entry set up. All I need you to do is to tell me what I debit. What do I debit when well, let's say we now because we want to go to us being the business, okay? What do we debit when we issue bonds payable? What do we debit? What are we receiving?
Cash.
Man, say again?
Cash.
Cash. We're debiting cash. That's correct because that's what we're receiving. So we're going to debit cash. And it's for the $100. One thing about cash, if you're debiting the credit in cash, there is no mystery surrounding that either. It is what it is, okay? So we'll always get that part right. Now, we're receiving cash because we're issuing a bond. So what do we credit? Bonds payable. That's perfect, okay? Bonds payable. I'm going to abbreviate this bond pay just for the sake of space, okay? So that is our entry. That is the base form of an entry, right? And this bond, it will pay interest. It's going to pay some interest, okay? Will pay interest. That's basically saying that we will pay interest, okay? So this bond is going to pay interest. Now, when we talk about interest, I'm going to put a star here and come over here because it has nothing to do with here, okay? So when I talk about interest, the interest that we pay is known at that time. Okay, it's known at that time. Now, it's two components that goes with that. Think about it. Let's switch up a little bit. If you need some money from me, then you're going to ask me how much I'm going to charge for interest, right? And so I'm going to tell you that. If we now are going to loan them some money, then they're going to tell us what type, if we borrow money from them, then we're going to tell them how much interest they're going to receive. They're going to know that up front. Isn't that a fair transaction that they know up front how much interest it is? So they're going to know how much interest they're going to receive. That amount is called the face value. The face value, or the face amount of interest, okay? Or the interest on the note. The face amount of interest is what it will pay. The face amount of interest is what it's going to pay, okay? So the bond payable, there's going to be interest that we are going to pay. Why are we paying it? Because when we issue the bond, we got some cash for our business, and because time is going to pass, we owe them some interest because that's the right thing to do. Everybody agree? Okay? Now, that's the face amount. I want us to understand though, why, and I'm going to ask you to say this. Why are we issuing bonds? Because we need some what? We need some cash, right? We're offering 10%. That's not bad, right? Who do you know that you can get 10% return from? Anybody? Well, we're going to offer 10% return. We think that's a good rate, right? But guess what I just found out? Somebody else is offering 15%. Now, where do you think they're going to go? Are they going to give us the money? Are they going to let us borrow the money? Or are they going to go to the 15% bank? What's going to happen probably? They're going to probably go over there, right? Now, if they go over there and we can't get the $100 cash, that's a big $100. It doesn't look like a lot, but that's a big $100. We can do a lot with that, okay? So think about it. The face amount, what is known is that we already told them that we're going to give them 10% interest. They found out, I did too, I didn't tell y'all this, but they found out that they can get 15% somewhere else. Here's the dilemma. Don't we need this money? We do need this money, right? All right, so since we need the money, what are we going to do? Well, I'm just not going to pay no 15%. That's just unreasonable. Well, you don't get the money, okay? It's just that simple. Let's make it a little bit bigger then. Let's make it $10,000. We just don't get the $10,000. We can understand that, right? We just don't get the $10,000. Remember what I do to one side, I can do to the other one as long as they're equal. So that's $10,000. But we really need this $10,000, right? So what are we going to do as a result of that? Are we going to let them walk? Or are we going to make a deal? Make a deal, right? How about, and I'm telling you this up front because I want you to really feel the effect of it. And these numbers they're not like exactly right, but they're just kind of fictitious numbers. This is what we would have had. But I'll tell you what, it's not going to work. Keep this up here. If you write it, you can just write an X to it, but it is good. But that's not going to work. What we're going to have to do is we're going to have to issue that bond regardless. We're going to have to get this money. So we're still going to have to give away a bond. This at the bottom, I'm writing bond payable at the bottom as a credit. Bond payable for $10,000 is going to be for a credit, right? Because I'm still going to have to issue that bond. I still need this money. We're going to make some kind of deal. And instead of getting $10,000, instead of getting $10,000 cash, is it okay if we get $9,500? Because we can still do a lot with that, right? Can we get $9,500? That's going to be acceptable? Okay, so we're going to get $9,500 in cash, and that, even though it's not $10,000, we can still make a nice return on it. Okay? Does this add up? Is this even? Do my debits match my credits? I have $9,500 in cash, debit, and I have $10,000 bonds payable. Does that add up? That doesn't add up, right? So something's going to have to be done about that. Well, think about it. This was a scenario now. We needed $10,000. We thought we could go and do it. We're going to offer 10% return. But they said that they can go somewhere else, and it's true. They can go somewhere else and get 15%. So we're going to drop this and only get $9,500, and we're going to sell it at a discount, right? We're going to sell it at a discount. So this difference here, because my rate was 10%, but the market, somebody else, the other banks, they were offering 15%. I had to accept a lower amount, which means I'm selling at a discount, because what do you do when you go to this? If you're selling clothes, right, then do you sell the clothes? Well, I paid $10,000, I paid $100 for this shirt. I'm only going to get $100, I'm only going to accept $100. But if you really need that money, somebody will give you $90. So you're going to sell at a discount. That means that you basically have given them a $90 shirt plus $10. That's really what you did, but you're going to benefit by getting $90. So you're going to give them this $10,000. You're going to give them. You're only going to receive $9,500, and you're going to get to pay them 10% interest plus the other 5%. That is going to be the difference right here, which is your discount on bonds payable. I'm just going to put discount because I don't have a lot of room, okay? So the discount on bonds payable is what I'm going to pay them. So let's make sure we understand, because I don't want anybody to be misled about what's going on. We really thought that, and by the way, think of me as your spokesperson right now. We're all in the same place, but I don't want you to think that I stole money, right? I don't want you to think that. So I'm trying to explain this as clearly as possible. Ladies and gentlemen, we really thought we were going to get $10,000. Unfortunately, we were offering 10% and someone else is offering 15%. So what I did is, I said to the customer, I said, look, we'll still give you a $10,000. Please let us still borrow $10,000 in turn. Excuse me. So I said, please let us borrow $9,500. Let us borrow $9,500. We need $10,000, but we know you can go somewhere else. So please let us borrow $9,500. We will give you $500 plus the 10%, and that will make up your 15%. Ladies and gentlemen, was that a good deal for us? It's up to you, seriously. It's up to you. Was that a good deal? Who says it was a good deal? Who says it's a bad deal? Let's try this again. Who says it's a good deal? Nod your head. Okay. Who says it's a bad deal? Go this way. It's a bad deal? Okay. So it's a good deal, right? And think about it. If we don't get this $10,000, this may have been a bill to our suppliers. If we didn't pay the suppliers anything, if we had said, no, only thing I want you to do is get $10,000 bond, if we didn't pay our suppliers, then what? We would not have been able to buy any more inventory and we would have really went out of business. But at least if we were able to get $9,500, we can now go to the supplier and buy some more computer parts to make all these new computers that are totally secure, right? We can do that now. And we'll only have to pay an extra $500 on top of that so that the other person gets what we call an effective interest rate of 15%, a made up interest rate. Because remember, we're still only paying 10%, but to come up with the other 5%, we just had to give it to them or just only accept $9,500, okay? Does that make sense to you in terms of why we're doing this? The thing is that we need this money, and we know that if we don't make this deal, that they're going to go somewhere else. So what we say is that, look, we'll only accept $9,500, even though we need this. We will give you $500 right now on top of the 10% interest that we were going to give you earlier. Now, these numbers will be maybe $94.50 or something like that, but that's just to make the point that the investors happy because they're getting 15% return. We really are happy because we had no way to get this cash in. So we're happy with the $9,500, and we are more than willing to pay this right here because when we get that inventory in, we're going to make that in more. If we don't get the inventory because we didn't do this deal, then it's going to be lights out for us, probably literally, okay? Does it make sense to you? So what is going on once again? Anytime you have a bonds payable, there's going to be interest. Why do we issue bonds payable? Because we need cash. We need cash, okay? Now, we know we're going to have to borrow the money, and we already have to determine what is our interest rate going to be. We said 10% this time, but whatever it is, we've determined what that interest is going to be right here. The investor knows that. But the investor, just like you and me, are shopping to see who has the best money market rate, who has the best stock return, who has the best anything, the best CD rate, okay? Who has that? They're shopping. They need to do that. And we know they're shopping, so we said, look, instead of $10,000, we'll accept $9,500. We'll give you $500 plus the additional, and everybody is happy. That's what we do with a discount when we issue a bond at a discount. This explains your journal entry. In particular, it explains the one for brief exercise of 10.8, okay? And basically, you can just substitute your numbers in there, and you will have the answer to that problem. But more importantly, I hope you have an understanding of why it's there, okay? Does that make sense to you? Everybody good? Okay. So, just to recap one more time, because the recap is going to go into what we're looking at. We started a business. We put $2,000 cash in, right? We didn't know that our business was going to grow this fast. So first thing we went out is we borrowed some money, right? We borrowed some money. Now, we borrowed some money and we gave a little bit of equity in our corporation. But the business really took off. And if we didn't get this $10,000 deal, then we were going to be behind. Who really expects your business to go from to grow by 3 times in 1 month? Did you expect that? We didn't really expect that. We thought it was going to be one of those slow growth things. So what we said was, look, We need $10,000, we're gonna pay 10%. That, we thought that was good. Come to find out, the market was paying 15%, but we found somebody that said, look, give us $9,500, we'll give you the $500 plus additional, so that's $15,000, that's 10%, that's, 15%, and so we basically issued the bond at a discount so that we can get something over here. And of course, this journal entry would change a little bit, but that journal entry would be a debit to $9,500 instead, and a credit to bonds payable, and a discount to bonds payable to the discount of bonds payable over here. So the discount of bonds payable account goes here as well, okay? So discount on bonds payable. This is discount on bonds payable, and remember, the discount is because we basically lowered the amount of bonds, so it will increase with the debit, okay? So that's issuing the bond discount. But we don't like to be giving away money. I know we needed it, right? We did need it. We really like to give away money, do we? No, we don't like to give it away. But guess what? Next time, we still gonna only offer 10%. And that's okay, right? Guess what just happened? They just made some new laws, and now the best rate out there is 3%. We still giving 10%, right? What's gonna happen? Instead of selling at a discount, can I charge a little bit more for my bond now? Since I'm the best show in town, I can do that, right? You know, the best sports team gonna charge more than the not best sports team, right? Because they're worth more. So I can charge a little more. Think about it like this. If you take your exam online, right? If you pay early, you pay early. If you pay like the day before, you have to pay more, right? That's called paying a premium. You're paying more than it's worth. Now, it's worth it to you to take that exam online, right? But it's still a premium. It's a premium that you have to pay. It's only worth, I don't know how much it is, maybe if it's worth, what, $10 to take the exam, but instead you have to pay $13 or $17. Whatever it is, you have to pay a little bit extra. So in a situation where we now, going back to the bond, where we can offer more than everybody else is offering, we can issue stuff at a premium. That's a good position to be in, okay? What does that look like? That looks like this right here. This here was at a 10% interest, okay? Discount, you're probably not gonna be able to see, but this discount here was at a 10% interest, all right? I don't have any place to write this, but I'll try to put it here. 10% interest. Okay, now, if we are still offering 10%, but the best they can do is 3% out there, we can offer at a premium. So now, instead of getting the $10,000, guess how much we're gonna get now? We can sell at a premium. We can get cash of $10,700. I really want to use the same one. I want to use the same out here. We get cash of $10,700 now because we have the best show in town. I'm going to use red. I know I already used it here, but this is a different type of red, okay? Let's just call it a different type of red. So why am I getting $10,700? Why are we getting this? Because we got the best rate in town. Only thing they can get out there is 3%. But we can get them to pay a little bit more. We're not price gouging. It's just that they want to come to us because we're still offering 10%. But we can pay a little bit more, okay? Just like when you want a certain ticket and resources are running low, you're going to pay a little bit more, right? So that's what we have. The bond is still only going to be worth $10,000. So one thing I want to make sure you understand, the bond amount never changes. The bond is worth $10,000 and it pays 10%, whether it's issued at a discount, a premium, or face value. This line, bonds payable, never ever changes. Bonds payable never changes. No matter what you issue at, okay? You have to keep up with that because this is a 10% bond. You might have some 4% bonds. You might have some 13% bonds. And you have to keep up with that as you go. So the bonds payable amount never changes whether you issue it at face value, this would be at face value, at a discount, what we have in black, or at a premium, which is what we have now. So once again, we're the best show in town, right? So now we can collect a little bit more up top. So since we collect a little bit more up top, once again, we're not balancing, right? We have to balance this with another account. This account, I'm going to squeeze this in here, is going to be called a premium on bond payable. A premium on bond payable of $700, okay? So this is going to go, same type of thing here. Let me get this down a little bit here. A premium on bond payable is still an account that we have, and that is what the bond is going to be worth. It increases through a debit, okay? I mean through a credit. It increases through a credit, all right? Now I'm going to write this again a little bit clearer, but do we understand the concept of what's going on? Everybody good with that concept? Okay, so in general, I'm going to recap it here, then I'm going to erase it, and probably erase up a little bit so I can have some extra room to write it. We need money. We started our business, it grew, we kind of gave a little bit of ownership there, but then it grew so fast, we had to get some money from somewhere. We had to get that money. And so what we did is we issued a bond. We tried to issue it at face value. Matter of fact, it changed so much, literally, at 1 o'clock, we were willing to issue that at 10,000. And everybody really was going to jump on it. But then they found out that they found out later about 115 that they didn't get 15% everywhere. So we had to make I had to make a quick decision for you because you were doing other stuff, but you trust me, you had to make a quick decision that I can get you 9,500 and pay them 500 and pay them 7% interest as well, 10% interest as well. That was issuing it at a discount, okay? But then, just moments ago, we were able to issue another one because the market went down. It's only paying 3%, right? And so because it's only paying 3%, then we could charge a little bit more. So I kind of got you a better deal because I was able to issue at a premium. Now, we may not believe that these things change that fast, and I don't have anything from a bonds payable standpoint to show you. But this is what I can show you. If you just look at a stock, any stock, what's the stock you want to look at? Anybody want to buy a stock? How about Microsoft? Sound good? I can't see it. Microsoft. Now, once again, this is not a bond, but this is just kind of showing us something here. Today, we see that this Microsoft stock is sold at $380.50 at 8 o'clock, at 8:30 this morning. Look what it's selling for now, $372. Now, that's just a stock, right? But these market rates can change as well. Now, we don't have that type of access to the market rates, but that's just kind of show you that, yes, it can change that fast. All right? So everybody good on that part right there so far? Any questions? All right. So let's continue on there. Remember, that goes with brief exercises 10.8 and brief exercise 10.9. There's not really a lot of different ways to ask that question, okay? So that's what we have there. Now, let's keep going and let's go to E, exercise 10.4. E, exercise 10.4. It's very similar, except for this time we're going to talk about notes payable, okay? E, exercise 9.4. I mean 10.4, excuse me, exercise 10.4. All right, now this is going to have some different journal entries here, and we have 1, 2, 3, 4, 5 exercises here. So we have 1, 2, 3, 4, 5 journal entries. 1, 2, 3, 4, 5 journal entries. Okay, so this is going to follow the same concept that we just talked and kind of we talked about the other day. And so for now, we're going to talk about notes payable. I'm going to erase these couple of ones. We'll come back and do those later. I want to add notes payable in here. With these, I'm going to erase each journal entry because we don't have a lot of space left. All right. So with notes payable, I'm going to erase this one. And just so it balances, I'm just going to add that over there, okay? Let's add notes payable. Notes payable is a long-term liability, and we increase any liability with a credit, okay? We increase any liability with a credit. Now, notes payable are going to last a lot longer than your normal amount of time, so we're going to charge some interest with it. That's going to be the biggest deal. So let's look and see what we have here. Once again, we're always looking at this from our company standpoint, okay? So, our company, why are we issuing notes payable? We're issuing notes payable because we need money. Why are we issuing bonds payable? We're issuing bonds because we need money. Later on, we issue stock because we need money. I'm not saying it's a right or wrong way to go about doing it, but it's what's comfortable to you and what's comfortable to your investors as well, okay? So with this notes payable, the first entry we have, this is E, and you're gonna have different numbers, probably gonna have different numbers. E, exercise 10.4. This company is going to borrow $46,950 from the bank. Now, they're gonna have some other stuff out there. This is a 9-month note, and it's paying 8% interest. Now, the months are easy, the days are easy, we understand that, right? But when we come to an 8% note, when they're saying they're borrowing this money and it's an 8% note, that 8% is what we call the face value. And we talked about this with the bonds, was the same thing here with the notes payable. This is going to be issued at a face amount of 8%, okay? So now, this has nothing to do with what's going on in terms of us writing it, because one thing about notes payable is just going to be very simple and easy, okay? So from a debit and credit standpoint, we have that notes payable there, and we're always going to have some cash that's involved with it as well. And of course, that cash will be debit. We're not going to put an amount there because we're going to change it up as we go, okay? So when you borrow something, when you borrow that money, and it's coming in the form of notes payable, then you're always going to debit what you receive, which is your cash, and you're going to credit the liability, which is notes payable. I receive cash, an asset, that goes up. I have incurred a new liability, that has increased, okay? And that's going to be for the face amount of that note. In this case, it would be $46,950, okay? Your notes may be a little bit different, but when that note was issued, that is what the amount that you received, and that's how much that you owe, okay? Everybody good? All right, now you remember I talked about bonds payable, and I said you have a 2% bond, 3% bond, 9%. You have all these different types of bonds. Well, when you get to these businesses that are so big, let me say this way, if you want to expand and you don't have the funds, this is when you start doing it. If you have all equity, that's fine, no problem at all. But if you have to borrow stuff, you know, like I just told you, these rates can change. In the case of here, from July to November, which is a longer period of time, the rates change. This same company, remember, on July the 1st, they just borrowed $46,950. Later on, they're going to borrow $50,000 in November with a 6% note, okay? So, I know you can't do this on your drop-down menus, but I'm just going to do this for tracking purposes. This is an 8% note. This is an 8% note. Later on, I'm going to borrow some money. It's going to have a different amount of interest, a different face amount of interest, okay? That amount will be 6%, okay? So, regardless of what the face amount of the money is that, regardless of what the face amount of the money is that we borrow, the journal entry is still the same for notes payable. Okay? This doesn't depend on what's going on out there. Well, it does, but for our purposes, this does not depend on the market like our bonds payable did, okay? So no matter what kind of note you have, 8%, it could be interest-free note. It probably won't be, but if it is, it's still going to be the same amount. There's no discounted premium associated with my notes payable, okay? So that's two different scenarios we have right there. It's very similar to a face value bond payable. where you would have still, remember, you only engage in this because you need money. You only issue this because you need money. And outside of what you give in the green, everything else is going to be done because you're raising money, okay? Now, for different reasons, but you're raising that money. Now, here's the situation we have. With July the 1st, we have July, August, September, October, November, December. That is 1, 2, 3, 4, 5, 6 months. July, August, September, October, November, December. I have 6 months from now to the end of the year. Okay? 6 months from now to the end of the year. Why is it important? Because remember, we don't prepare our journal entries every day, right? I mean, more than likely, you're not going to prepare these journal entries every day. So that's understandable. For a small business, maybe once a year. In this case, it's going to be once per year. We're going to prepare these journal entries at the end of the year, okay? So we borrowed this earlier. Now, it'd have been good if we had done that. Trust me. It'd have been very good and very helpful. I don't like doing it at the end of the year, but sometimes you do, okay? So this one happened in July, and this one happened in November. All right. Now, we borrowed this money, and we have to pay what? Now, this time it's us. When we borrow money, we have to pay what? Interest. That's right. Let me ask you a question. We borrowed this, and forget the amounts, okay? Don't worry about the amounts right now. If you borrow money in July, and then you turn around and borrow some in November, which one are you going to pay the most interest on? The one in July or the one in November? July, because you had it for the longest, right? So that's just kind of to make us understand that this is why, or this is how we compute our interest, okay? The why part is based on when, even if it was the same amount. Now, obviously the amounts make a difference, but if it was the same amount, it's only based on the time that you had it. Just like depreciation, you can only allocate it over the period of time you have it, okay? Now, the 9% one. We need to figure out how much interest we have. So, have a calculator here. The first note that we have is in July is $46,950. $46,950. Remember, this 8% note, this is my face value, just like the face value that we had on our bond earlier. The face value is always the amount for the entire year, okay? It's always quoted here on an annual basis, all right? So this is the 8% for the annual basis, right? If I take my $46,950 and I multiply it by 0.08, I'm going to get $3,756, okay? So I know on July the 1st that I would be paying $3,756. Everybody clear on that part, right? It's the end of the year now. We've gone through all of July, August, September, October, November, December for this note. True or false? I'm going to pay $3,756 at the end of the year. Who says it's true? Who says it's false? That's correct. Because I only pay. Now, that's for a year's worth of time. We don't even own a note for 9 months, okay? We only own the note for 9 months. So, we're not going to pay even that amount. We're only going to pay for the amount of time we had it, which was for 6 months, okay? So, let's make sure that we understand that every time we do this, we have to compute the amount of interest that we had for that certain period of time. All right? Now, 6 months worth of that interest will be $1,878. And let me show you how you can think of this, okay? No matter which method you choose is fine. It's just whichever one works best for you. Literally, seriously, whichever one works. Sometimes it's easier for me to maybe put an extra step in, okay? So you don't have to put the extra step, but if you do, that's fine. We have $46,950. All right, and that's at an 8%. at 8%, and that gives me $3,756. $3,756, okay? So we agree that this is the interest for an entire year, right? Interest for a year. We only have it for how many months? 9 or, let me see, how many months do we have this for? We have it for 9 months, okay? Now, what I would do is, I'm not gonna say what I would do because this is one of the ways I would go about doing it. I would take my $3,756 divided by 12 so I can get the amount that I have for each month. And that would give me, how much would that give me? Divide. If I divide 3,756 by 12, how much would that give me? 313, okay? 313. Now, for January, for February, for March, for April, for June, for July, August, September, October, November, December, that is 6 months. So this is an annual amount. This here is a monthly amount. And I'm going to multiply this by however many months I have out, in this case 6, and that will give me $1,878. That is my interest expense for this year. That is a what? That's an accrual, right? I have a journal entry that's going to go for debiting interest expense. I'm going to credit my interest payable. And I'm going, and remember, this is an income statement account. This is that's an income statement account. This is a balance sheet account, okay? That's that same concept we had from chapter 4. We just use it for a different way, okay? So my interest is only based on the amount of time that I had it outstanding. Now, let me ask you a question. Why not just credit cash? You don't have to tell it, but if you think you know, do this right here. If you don't know, do this right here. Okay? The reason I didn't pay cash is because they didn't tell me I had to pay cash. I don't have to pay when it's due. But I needed to make sure that all the interest related to that year stayed in that year. Okay? So that's why we do accruals, to make sure that whatever period it's in this case for that year, it stays within that year. That's why we have an adjusted entry, one more time, accrual with an income statement, a balance sheet account for that. I will pay this next year when it's due. But I had to accrue it with this journal entry right here to keep it in the term where it was, okay? Now that's for the first note. But I also have another note as well. And that note is $50,000 at 6%, right? What number should I have for that next one? I'll let you try that one, Wayne. What number should I have for that next one? If I have a $50,000 note with a 6% interest, that 6% is for the entire year, right? So go ahead and compute that part. 6% times 50,000 is going to give you some number, right? Then divide the number by 12. Just replace that number, divide it by 12, and you have it for your month. Now the difference is, how many months is this one outstanding for? We got it in November, now it's December 31st. So how many months did we have this note for? For 2. So I will multiply it by 2, and I'll come up with how much? $500. That's correct, okay? $500. And that's what you call an accrual or an adjusting entry, and it's both of them actually. You're doing both of them in this case right here. It's referred to as accruals here, and that's probably a better name, but it isn't. You're adjusting some of the stuff you have, okay? So that's what you have there. Kind of similar to what we did a little bit, but are you getting more comfortable with it now? Probably, okay? I know we had a question on the last test where you had, this was the amount right here, this was the interest amount, this is how long you had it. That's what this was kind of preparing us for, okay? Can we keep going through that problem now? All right, now, the good thing is, good or bad, I think it's a good thing, because I don't like to owe anybody, right? We're going to have to write this off. I mean, we're probably going to pay this off. So, can I erase this part right here? Okay, all right, only because I need some room here. And this is going to be kind of similar to what we have for our bonus payable as well. We're going to do the notes payable here, though, with this entry here. Now, I need to pay that note off. Let's just think through it before we start writing it. I borrowed some cash, I debited cash, and I credited a liability. When I pay my liability, well, when I set my liability up, I set it up with a debit or a credit. I set my notes payable up by debiting notes payable or crediting notes payable. If it's by debiting, nod your head yes. If it's by crediting, nod your head yes. That's correct. So, in order to remove it, I will now, you can barely see that I had put cash in notes payable. You can probably barely see it there. This here was notes payable. It was credited when I set it up. So now I'm going to debit it for the entire amount of the notes payable, okay? This is going to be a debit, but I need to come in because I'm going to do something in a second. Notes payable. Now, since that's the biggest, remember, I don't like owing anybody, I really don't. So I think for me to get that off, that's going to be the first thing I want to do. So I'm going to, this is just a reminder of what I like to do. That's the first thing I'm going to do is get that off. Okay? Now, I'm going to pay it off using some what? Some cash. So am I going to debit or credit that cash? I'm credit because I'm getting rid of it, okay? So this is going to be a credit to cash. That's the second thing I'm going to do. I'm going to put this on. You don't have to do it in this order, but this is just my line of thinking. I want to get rid of that note, and I want to pay out all the cash that I owe, okay? Now, there's some more things we have to do, but this is the structure of what we have. One thing and two things. Now, what else do I have to do? This goes for both of these notes, okay? I have to also take care of the interest, okay? Now, you remember at December 31st here, I had some interest that I had to pay, right? These notes are going to be due next year, but I accrued it from last year. So that is right there. I need to, okay, one more thing that we talked about before. The reason I did this accrual is to set aside the money so that I can pay it off later on, okay? So what am I going to do? I am finally going to pay this whole note off. When I pay this whole note off, do I still need that reminder that I need to pay somebody? So I credited to set it up. I'm going to get it off with a what? With a debit, right? So now I'm going to debit interest payable. All right. I'm going to debit interest payable. We good? Now, let me ask you a question. I borrowed a note in June. I borrowed a note in July. It was for 9 months. I bought another one in November. It was for 3 months. Quick question. I accrued it because it was not time to pay because it's not due yet. So later on February the 1st, when I pay off that July note, remember I had interest of last year for 6 months, and then I had, was it for 6 months or something like that? And then I had another set of interest from this year. What do I mean? If I don't pay it off until, I think it's February the 1st, then I have another month of interest for this year to pay, right? Isn't that correct? This is what I accrued last year, okay? But now I have another month worth of interest because I'm paying it off in February. Let me put it this way. I did that entry on December 31st. If I had turned around and paid it in January, then I probably just wouldn't even have that and paid cash, right? But I said, no, I'm going to wait. So that's for December of 2025. I'm not going to pay it till February of 2026. What about this time here? Isn't this some time that passed? Isn't this more time that passed? So that means I have more interest that's out there, right? So I have to compute the interest for the amount of time that passed. And this is going to be, whereas this is related to last year, 2025, then this interest, watch this, expense is going to be related to the portion that's still outstanding in 2026 until I pay it, okay? So I borrowed the note. At the end of the year, I didn't pay the interest because it's not due the next year. You know, in this case, I'm just going to wait the next year to pay it. But I had to make a reminder by putting this journal entry in, this accrual entry, to pay it later on. This is just simply a reminder. No cash has changed hands at all, okay? But it's a reminder. Once I pay it off, I can take the reminder off my books, right? Good, that part? Then I have this space between December 31st and here, and I need to account for my interest right there. So since I need to account for the interest right there, that's going to be my interest expense for 2026. This is my interest expense for 2026, okay? Now, how much would it be worth? This was for 6 months here, and let's see, July, August, September, October, November, December, January, February. Well, we didn't pay it all off. We only paid off 1 month there, so that means we had an additional 1 month for the first one. But the second one, we went ahead and paid it off. Now, is there anything else that I need to do? Because I have taken my notes payable. I took that off the books once I paid it off, right? I completed it. I paid out the cash. We agreed on that part. I paid out the cash, right? I also paid off all of my interest. The interest from last year plus the interest for this year for each individual note now as it becomes due, okay? So this together, the interest component is the last of my 3-step process to make sure I pay that off. It's going to be now, is that okay with everybody so far? Now, it's going to be the same thing with bonds payable. When it comes time to pay, that's why I wanted to have me a little room right here. Now I'm going to erase these 1, 2s, and 3s because I need my space. When I go to pay my bonds payable off, I'm still going to have to pay, well, no, wait, I like to get rid of my liability. I'm still going to have to take my bond payable off. Remember I set the bond payable up here with credit? So when I pay my bond payable off, I'm going to debit bonds payable, okay? So whether it's a note payable or bond payable, I'm getting rid of this liability, any liability. When we went back to accounts payable, there's regular accounts payable. When we paid that account payable off, we debited accounts payable and we credited cash what we paid. So it's no different. It's still liability, it's just a bigger sum, okay? With that bond payable, I'm still going to pay some cash. I'm still going to pay cash, right? So when it comes to our journal entries, we're not going to miss these 2 parts. And we understand what they mean. It means that I got rid of my liability and I got rid of my liability by paying cash. The only thing that we have to do different is that we're going to have, for this part right here, we're going to have some interest expense. That's interest expense, okay? We're going to have interest expense. We agree on that part. And then we're going to have that discount of premium. Now, I'm going to put a star by discounted premium because that all depends on what it was, how you set it up, okay? With the bond discount, it was a debit, so we take it off of the credit. The other one, we put it on the premium, put it on the credit and take it off of the debit. So we have to just remember what we did there. That's why I put a star there. But I wanted to show that we still have a 1-step process. We still have a 1-step process, 2 steps in the process, and 3 steps in the process, okay? So that's how we finish paying. When we finish paying off everything, this is what it is. Now, if it went out for 5 years, it'll be 5 years later, but we're still going to have to take the liability off the books, give up some type of asset, take care of our interest expense that we have in the current year, if there's any, and the discount premium and that right there, okay? And that right there being the interest payable, okay? And we have that for two different journal entries right there. How's it sound? Sound okay so far? Question? Any questions? All right. That's in general what we have. Okay. Let's see. Not let's see, but that went for E exercise 10.4. Okay, so that's pretty much what we have. You'll have another type of problem that has another different type of homework problem. Has to do with unearned revenues, but we've already dealt with that plenty of times before. Okay, so we know how to do those. We have our those stocks that we have. The only thing we did not cover was a stated value. Okay, so with your notes on a stated value, it is essentially the same. You just record it at the stated value. So you have your stock issued at par, issued at a discount or a premium, which we did, and then the stated value is actually what it is. You record it at what it is stated at. Okay, so that is your stated value, and that goes to a different type in terms of paying a little bit more. Let me do this part right here because I think this will help you out. Okay. These are the main ones I wanted to cover. Now we're going to go back to the bonds, okay? Because we pretty much have everything that is there, all right? All right. Actually, I'm jumping ahead a little bit. You mind if I jump ahead just a little bit? Just to kind of show the similarities. When I was talking about stated value, I was thinking about the next one. I really hate that I took that down. I'll tell you what. This is what we talked about today. We talked about debiting bond payable. And obviously, there's going to be some cash involved, right? Then we talked about that notes payable. This is more so for next time. That notes payable, and we had some cash for that, right? Why are we issuing these? Because we need some what? We need some cash. So what I say earlier, when we needed to borrow $1,000 here, and at first we had between 500 here in equity. Well, the same thing here. If we go back to when we only had 500, just for our purpose of what we have here, you don't have to write that down, but if we go back to what we had here with equity, when we give away ownership, we call that stock. Stock is ownership. The one we're going to focus on more so is common stock. And why are we doing it? Excuse me, I made a mistake. I apologize. This should be above. I apologize. All these are credits. All these are credits. We're going to debit cash because we gave away ownership and we received cash. We're going to debit cash when we have the notes payable, right? We're going to issue a bond. Remember, we're going to have to pay interest on that because we want to have some cash. So what this does right here is basically ties in chapter 10 and chapter 11. It shows that we're only having these issues, and I don't even want to say issues, that sounds bad. We're only having these entries right here because it's all about raising cash for some reason or another. Now, sometimes I might give away a little ownership, and that's okay. If you have a skill that I don't have, then why not go in business together, okay? So that's the reason why I could give away ownership. Or you may want to give away ownership to your family, whatever. Now, obviously, they may be called a silent part. They may not have the knowledge you have, but then again, we don't have the knowledge that Microsoft have, or Coca-Cola, or Ford, or Tesla. We don't have those. We don't have that kind of knowledge. So why you give away ownership is irrelevant. I mean, to whom you give it to is somewhat irrelevant, but why you give it away is the fact that I need some cash. I could have borrowed some from the bank here, or I could have issued the bond payable. All of those are debits. all these to the credits, okay? So this kind of ties together, which is what I've said all along. This is all we're worried about, liabilities and equity. Anything that increases is with a credit. Common stock will be a credit, that's the same thing. Notes payable will be a credit. Bonds payable will be a credit. And anytime I raise cash, we know cash is an asset, so that's always going to increase as well, okay? So that's actually going to tie into our discussion next time on equity. Any questions? Enjoy your weekend, your long weekend. Sometimes it might seem a little bit easy